All right. So, part two. And last week I talked about this 4-8 EMA ribbon strategy. And now I am going to go into the second part of this, and it's kind of the more interesting one. So let's get started here. So these are micro S&P 500 futures, and this is only a 15-second chart. Now, normally a 15-second chart would be crazy, but we're dealing with, right now, historic levels of VIX. And VIX is currently hitting the 2008 levels and actually managed to have a daily close above any higher daily close in history for the VIX since its inception was Monday, when we had a 10% gap down in the markets. And that was a huge moment, probably, that we might be generating some kind of a base here. But, you know, all bets are off in this market. This market's nuts. Never seen it before. It's taken 4 weeks to get back to the Trump inauguration, and it took 4 years to build all of the gains from 19 to 20,000 Dow Jones all the way up to maybe 29,000 Dow Jones. We wiped out 10,000 points of Dow Jones in 4 weeks. So that's pretty crazy. S&P 500 futures are about to hit the lower limit tonight, and that's unfortunate. It looks like it just every night for the past couple of days just seems like racing to the limits. And I keep plotting these because they keep becoming valuable in the next days to come. Today, for instance, on if we look at, let me look at the micro NQ futures. I've been doing a lot of micros lately. It's all I can do. When 1 minute candles for NQ are like 50 points, it's you know, it's all you can do. So maybe this is a big structure here that it's trying to build some kind of a bottom. Maybe. You never really know with these things. It can just keep going. So you never truly know. But one Fibonacci level is the 786 level, which happens to be right around this Camarilla R4 or S4 level. That's possible, if that's what it's doing, but you never really know. So it seems like bears might be running out of gas a little bit. So this being almost 786 makes me wonder that this could be a potential bottom here, but you never really know with this kind of stuff. So it's difficult to know. Anyway, let's go over this. So if we just pull up regular ES contract, let's go over this second part. So on my indicator list, I have something called this moving average ribbon, and it's kind of nice. It's really simple. You can set it to multiple types of EMAs, and for this example, I like the weighted EMA the best, or the weighted moving average the best. I like it better than both the exponential and the exponential volume moving average, and it works pretty good for what we're going to do here. So, similar to the 4-8 strategy, what if I went down to a 15-second chart, and instead of using a 5-minute chart, I went down to 15 seconds. So 4 EMA on a 15-second chart is actually 64 in length. I have this set to the fast length is 50, just because I wanted to use 50. 8 is going to be double that. So if you take 8 times 4 times 8 again, if this was a 1 minute chart, it would be, wait, I did that wrong. If it was a 1 minute chart, it'd be 128 minutes. If it was a 5 minute chart, it'd be 640 and 640 in length. So I just want to pull this up just because I want to see where this lower limit is actually going to hit right here. So knowing that, let's just go with 5,200 just because, you know, that's the common thing to use. So how do we use this and why does it work? The reason why this EMA ribbon strategy works is because first you wait for the flip down, and the best strategies are always some kind of a retest. If you're not just doing outright Camarilla pivot stuff, which we took a little long here, and normally you would have the first target would be back to the previous close, which is somewhere around this area. This thing actually pops up. Takes a second. Come on. Well, whenever this thing decides to load. TradingView has been really slow lately for me. I'm not really sure why. There it is. Previous close. So usually the first target is somewhere around back here, and then you take your second target back up to R3. So Camarilla trades have not really worked that well in this market. It's too volatile. It's moving too fast. And it's just blazing through these levels. It's not holding. Camarilla trading is not meant for this kind of a volatile market, in my opinion. And that's evident by most of the time it's just not working on the way down, on the way up. Maybe a couple of trades if you happen to get a Camarilla R3 on the way down. That actually worked really well as a short, but I'm not so sure if it's going to work now. So let's go over this. Starting at about, and people think that a 15-second chart is crazy, but it's not, because we're using 50 and 200 weighted moving average. So this was the close of the market back here. That was the NYSE session end. After that, we immediately dumped down. And here is how you do these trades. Just like on the 4-8 EMA strategy, we're just going to use a 5,200. This would work on a daily chart too. And we're going to sell and short every back test of the 200. So your first one would have been somewhere around here, and let me actually use the price labels. Somewhere around there. What I look for is I say, okay, what was the lowest 50 EMA, or what was the lowest 50 value at that particular moment along this curve? That's my target. I'm going to sell it there. That happened somewhere around right here. So this was profit number 1. And that was something like 10 points. Not bad. I don't like doing just, the regular moving average because this thing is curling up. So you could do this two ways. Right when you short, look at what the current 50 is and make that your target. Or look at what the lowest 50 was for this entire trend going down. You could do it two ways. It's up to you to backtest and figure out which is best. That's your first short. You can choose to close it all, or you can choose to say, hey, I have no idea how long this is going to last. Let's just hold some. So maybe we hold 1/3 of the trade. Here's your second. Right there. Close that short. That happened immediately right here. This is an immediate close. This was a gain of what? 79 to 87, 85. That was about 6 points. It happened again right here. Multiple times. So this is where you really rack the points in. I'm going to zoom in on this just so that we can actually see it. So if I look at this, you actually could have gotten a few here. And usually what I do is I say, okay, I'm only going to take one at a time until I get filled on the next move down. But you did take this trade, and you didn't get filled until here. So let's move this so I can get more That was your first fill there. And then here. And then you didn't really get any more. So you closed 2 more scalps. And each of them were about 8 points. And you're still holding 1/3 all the way down. Here's your next one. Maybe you took this one. This one looks pretty good, but if you're being strict, you didn't take it. You had a short here. And either your target is the 50 weighted moving average during this time or exponential, whatever you're using. If I switch this to exponential, it's going to look a little bit different. This never went green right there. Weighted is a little bit faster sometimes. Volume weighted that's exponential is going to take into account the volume. So this was like a perfect hit. Whether or not that was a coincidence, who knows? So here's the part where you have to look and say, okay, 50 crossed above the 200. I want to take my most recent high and I want to say, this is my new stop. 1 tick above this high. That's my stop. As soon as you see this happen, you just say 1 tick above the recent high, and you're going to have to figure that on your own just by your own bed's judgment. There's an algorithmic way to do this, and that's what I do. It just shows me it on the chart for a pattern, and then you just set that. So next short that you took that was successful, let me go ahead and replace these so we can actually have them all the same. Remember, we shorted here and our target was the value of the 50 at that time. This was our profit. We're still holding on to one. This is really close. Let's just say we took this one. Oops. Let's just say we took this one. This is just trading the 200. That's it. This is really simple. And, I mean, at this point, you're going to have to use your judgment. Do I really just want to take this tiny little 2-point scalp? Is that really what I want to do? Or would I just set my target to this guy here? Or would I set it to the lowest value of the 15 EMA, or weighted moving average, during this entire trend, which is somewhere around there? That particular instance would give me a 5-point scalp on that one. This is why we can use the 15-second chart. The targets are huge compared to 15-second. Normally, to get a 5-point scalp, maybe 2 months ago, I would have had to been on a 15-minute chart maybe, or more. Sometimes the daily range, not too long ago, was only a 10-point range for the whole day. We've got easily 150-point ranges right now. So there's your next one. Hold on to a third. So now we've got 1, 2, 3, 4, 5, and now we're getting into some pretty big profit, so far with this guy. This original short that we have now is a full 25 points in profit. So multiply that by 50, and you're doing pretty good. You're 1250 in profit. That's just for that. So, whatever your position size was. Maybe you're doing 3 micros at a time and you're holding on to 1. That's fine. But now you're really into profit. Look how much it's sunk so far. Here's your next one. Just keep taking them. You don't know when it's going to end. You have no idea when this trend is going to end. You have no choice but to take as many as you can. This one looked a little iffy, but it's okay that this went up. You know why it's okay? Because you got in at really good prices back here. All 1, 2, 3, 4, 5 of these, your average position is somewhere around, if we took the average of all of those, it's somewhere in the middle. Your current position is somewhere around here. Right? That's my current position. Somewhere around there. Oops. Somewhere up there. So me taking this position obviously is going to lower it a bit. Maybe it's somewhere around there now. And then I close that short. Either I do it at the lowest 50, either I do it at the lowest 50 moving average, or I wait for the, or I don't wait. I just do it at whatever the 50 moving average was back then. So maybe I just do this one right here. Right about there is where I took the next profit. And this one was 46, somewhere around 39, so another 7 points. And then I'm holding. And then here's your next one. Right there. Take that profit there. That's 41, 36. Now you're probably really pissed off that you missed out on all these trades that you would have had just shorting and doing this all the way down. And this is, I mean, you're on a 15-second chart, but you're using a 5,200 moving average. This thing is going to go slow enough where you can react. Here's your last short. At this point, I saw this big whoosh down like this, where it just went straight down and kind of curved and then stopped. This is usually a capitulation, and there's an algorithmic way to figure out what a capitulation looks like. And this one right here was a kind of a mini one, but not big enough. This one is a bigger one and can result in usually this one right here. So here would be your last short. You took that one. And you saw that this was a failure to go down. Usually that failure right there to go down signifies that this trend is over. So you did it. You got the short. You got the profit here. You did take this profit. Sorry. Turn the volume down on that. You got that profit right there. What was that? 19 to 14 for another 5 points. But you got stopped. You're about to get stopped out here. So the 50 crossed above the 200. You set your stop to this high right here. And the rest of this last position only got stopped out 3 points from the entry. And you closed 2/3 here. So this last position actually was a net win, because you closed 2/3 here. You know, you shorted here. You took some off here. And you had better than a, oh, this is upside down. You had better than a 1-for-1. Which means if you close half, this is still a winner, because your risk reward, your reward risk was better than 1. If you were at 1-for-1, if you closed half, you would break even, because half would have been closed here, the other half would have been closed above where you entered at exactly the same distance, and it would have been a wash trade. So right here, like, I'm gonna get in later. I'm gonna see if I can snag 3. And just see if I would have gotten in right here on this trade. But I'm talking to you guys, so we'll see what happens. And I'll just put my stop right up here. Just 3 micros. See what happens. And maybe I'll get into one more. Then update this. Usually I would have gotten in right here. That would have been my first trade. So this is where this fails. Walking through this next trade, here's your first entry here. Right there. You would have gone long here. Let's see if I can do one more. All right. Let's see what happens with that trade. Trying to get it back up to where I hear, because I missed this trade. And I want to see if we can actually break down into this lower limit and just hang out underneath here, because the highest bid will be down below. So here would be your first. This would have been your first long, and you would have taken that profit for 2/3, right about. Well, you got in long here, so your target was about right there. So this was your profit, and then you got in with 21. And right when you got in, the value of the EMA ribbon was about 30. So you got about 9 points. If you stuck it to the highest point of the 50, you would have barely nicked out a profit there. So sometimes it actually works, sometimes it doesn't. So you got that one in, and then you took this second trade. You would have taken this one again too. Right there. Right there. You did not get to here to take this profit. You're stuck in this trade. You're currently stuck in that trade. That's okay. Your net entry now is probably in the middle of these two guys for your long. Right here is where the crossover happened. And the lowest point was right there for the exit, which was this caused the flip of the 50 and 200. The lowest low before that was right there, and you would have set your stop right below that. Your net loss would have been somewhere around 6 points. For this, you already closed 2/3 of this one, and you're in profit. So this trade actually still was a profitable trade because you closed 2/3 up here, and the distance between your entry and your close was pretty good. This one was a net loss, so maybe this whole trade turned out to be a slight net loss. So that's okay. The reason why this trading strategy works is because you're buying this is the same reason why the ATR strategy that I've been talking about, that I've been building. You're buying super close to where if this 50 and 200 actually want to flip positive, you're buying really close to where that is actually going to occur. There's not going to, usually you don't just keep going and then just, don't have some kind of a retest. It wants to move around a little bit, go sideways a little bit, and kind of just move and do whatever it's going to do, and then finally drop. It usually just doesn't blast through your stops. So now what I'm going to do is I'm going to say, I'm going to buy stop. Let me put this in a break even. It got far enough away. Let's see if they want to reverse this thing really fast. And if they do, then, I get out of this trade. But we'll see. I'm only doing this because we're so close to the lower limit. They could totally just wipe this thing out and push it back up again. People are watching these limits now every night, so you never know what's going to happen. So that's kind of the gist of it, of this, the way that this is actually working, and why this makes money is because you're buying so close to the location where even if this thing does flip, you're not that bad. And because you got in and you started trading at this is the key part. You started trading at the very first flip instance. So you got in really early to this trade, and you have enough of a cushion all the way down where you're like, by the time I got down to here, my net short was probably around here somewhere. By the time I had all these trades locked in, including this one, maybe it was around here. I don't know. Probably maybe a little bit further down, maybe around here. Not sure. If you average all 8 of these trades on the way down, that's a good trade. Look at that. All of these this whole net short for all the ones that I held got stopped out here. That's this is if this is what I'm estimating, that's a 50-point gain for all, and the only one that barely didn't get any money, even though it actually did make money, because as a net you close 2/3 here, and I say 2/3 very specifically and not half, because you really only want to carry a third on the way down. You want to lock in those scalps. Closing half might not be enough. Closing 1/4 might be too much. This is actually a net win right here. So this is a very profitable trade on the way down. 50 points is that's a respectable ES gain. And this all happened in the course of from 1640, then you had the 1 hour break, and then this is only 2 hours and 20 minutes or an hour and 20 minutes of trading. So that's not bad. That's pretty good. So if you can pull off this stuff, and if we go back to the middle of the day, you have a similar setup at the beginning. Here was the beginning of the day. Let's see. Could not think for a second. I don't know what just happened to me. So let's see here. 9:30. Maybe wait 30 minutes and see what the market's going to do. Maybe not. You would have taken your first short right here, and that would have been a failure. This is pretty close. So you can sometimes say, okay, well, what if it gets to 61.8% between the 50 and 200, or just divide those by 2. So if I take 50, if I take the distance between 50 and 200, 200 minus 50, times 0.618, add it to 50. 61.8% between both of these is a 142.7. Just do it to 142. And you saw that you got a little strike there. That is 61.8%, but we're not really doing that. So you could do that if you wanted to. So now this trade that I'm looking at over here is doing pretty good. Okay, stopped out. 150 bucks. Decent. Yes, I'm a multitasker. I was just showing that this is possible to do these trades, but I just wanted to lock that one in. Normally I'm doing one contract at a time, one ES or 2 ES at a time. So here is the first trade, stopped out. You got in here, you were stopped out somewhere, around here. So when this flipped, you were immediately stopped out because the previous high right here that's going on that you're looking at, as soon as this thing actually flipped up, it was already above that. So you would just market close this trade. So you would have been stopped out somewhere around here, right? And 88, you took a 16-point loss on that. So whatever, you're gonna make it up. First buy, boom. Looks like we're heading back up again. So they really wanted to tease that little limit down and then bring it right back up. What is this? 88, 97, 9-point gain. We're over halfway of making up this loss. Now we're holding some. Next trade. Right here. 05. And what was the profit? Somewhere around here where we got it. So up here a little bit. 16? Or 12, yeah, so that's a 12-point profit. So we're doing good. And we're still holding 1/3. You're going to kick yourself when I show you how much money you could have made after the 10 o'clock and just waited 15 or 30 minutes. Next trade, right when this thing actually hit was right here at around 25.25. We didn't hit that until right there. So that was another 9-point gain. Still holding 1/3, 1/3, 1/3 on this. So this whole trade is probably somewhere around 20 points in the money now. Now this thing really picks up. Great. The reason why we don't keep buying anything is because we need the pullback. Here's your next buy. 24.66. Look how much money we just made. It's insane. Now you understand why I'm using this 15-second chart. This is easy to watch. You're literally just following the price and putting a limit buy on here and just buying it immediately. This flipped over. We set our stop to here. This is our new updated master stop. I forgot to say that. This never goes away. This is the updated master stop for this whole trade. Once we get a flip of 50 below 200, that's why I like the weighted moving average, because exponential probably did not show that. Nope. But it did show exactly where you should have bought right there. But maybe you missed out on some of these trades down here if you used exponential. Nope, you got them all. And you got this little baby right there. Little baby trade right there. This one you kind of had to use your discretion. Maybe just use one ATR for the profit target. Didn't get it on weighted. So you got this guy. I mean, you got to back test this. This would be super easy to create a back test on this to see how good it works, to see how good it is. So your target is here, where the 50 was when this hit. That didn't get hit till maybe right here. And that was about a 9-point gain. So we're getting a 1 minute ATR's worth. The 1 minute ATR throughout the day was between 8 to 14 points the whole day, and we're getting somewhere right in the middle of that, sort of like more towards the lower threshold. So maybe let's see here if let's see if exponential moving average hit this. Nope, not even close. So exponential. That's one of the reasons why I like weighted, is because exponential moving average, your stop is going to be much lower. So exponential didn't flip until here when we get stopped out of this trade. Weighted flipped way back up here. Exponential weighted maybe somewhere in the middle of that. Yeah. Whole moving average, I don't know why people are obsessed with this. I think it's freaking junk. I mean, look at this. This sucks. Simple, not so great. It's going to take a while. Simple, not good enough. You need some kind of a filter on it that prefers the difference between exponential and simple. Simple is just a net average, so the average of the previous 200 closes. Exponential prefers the most recent close and applies a greater weight to it than all previous 200 closes. So it has more of a weight, so it moves faster. So we got that, and we didn't get in this trade, but we're in this trade, and we closed some for profit, and now we moved up huge. That was a huge gain right here. We could have just dumped all of this up here. And what is this thing up here? This is the 200 period Bollinger Bands on a 5-minute chart. It's a multi-time frame Bollinger Band that I can use, and I use 5-minute. And you can set to just always use the chart interval if you want, so just go to 15 second. But I'm using a higher time frame, 5-minute, with 200, and one of the standard deviations, the inner one, is 1, then the outer one is 2, and then it's just a shading that's applied in between. Why do I do this? Because it shows me things like this. Big places where there's possibly, if it went this far to get here, it's probably not just going to just keep punching higher and go even higher through. Just like back down here, behind this line, that we're kind of moving sideways now, so hits on 200 on the 5. I don't know why, but 200 period Bollinger Bands on 5-minute, 1 hour, and daily have significance. And just to convince you, the NQ chart on the day chart with 200 period Bollinger Bands actually hit right at the bottom at 2 standard deviations away from the 200-day moving average was this lower hit down here. It was also, what's this guy? It was also this. All of the indices in one way or another hit their master 2009 trend line. And the only way that you can show it on NQ is you have to put it to log chart, let me actually and do this guy right here. This trend line here is how I derive that. But on other charts, DJI, you would actually connect it to the bottom. And there's one of these, I think 2015. And you'll see, and SPX too, you'll see that we all hit this trend line. This is the line in the sand. These trend lines broken signify the end of the bull market that we have been in for 11 years. So that's how this works. If I go back to the micros for ES. So let's take a look at this trade that started out. You could have just walked away the rest of the day. That was a good day. And you got stopped out somewhere around here. So remember, every time the 50 crosses under the 200, we update our master stop for the whole trade. This whole trade is now well within the money. And then this crossed under here, and the lowest low was back there for this, you know, you pick a low back here, and we would have been stopped out right there. Right there. Somewhere around there. Oops. So I would have updated this. And I would have been stopped out there. So here's my final stop out. Every single one of the trades that I took, except for this last one. If you took this last one, it would have been a total loss. You would have lost 16 points on this trade. Your scalp never filled, nothing filled. But you've got to use discretion on other things. You're waiting for these big whoosh moves like this, where it just goes straight up. And then, you know, kind of, not so much this one. It's a specific shape, and you really have to have been trading a while to see it, how straight up it is. And it takes a while. Sometimes, and a lot of times just don't even guess, just, you know. But this, for some reason, this 5-minute 200 period Bollinger Band with 2 standard deviation, it really works. I don't know why. If you were on like a 15-minute chart, use like 50 period moving average or something. I don't know. 200, if we divide by 12, is equal to a regular 16 periods, just rounded up to 20 maybe, for 1 hour chart. So that could be one of the reasons. We're just expanding it to a 5-minute chart to see what happens. So that's the trades. You know, you had more of these trades on the way up, and it didn't go so well after 12 o'clock. The dead zone, I call it, is not really a great time to trade. This was a pretty decent trade right here that you could have had in the middle of the day. You took this profit down here for maybe 10 points, 9 points, and then, but the rest of the trade, you know, didn't do so well. You exited right here. You could have just said, I'm just going to take, you know, some kind of a profit. Maybe you looked at this and you said, if I look at this, I'm probably eyeballing this. This looks like a 1.618 extension. I know, I've been doing this a long time. If you've been doing this a long time, you can eyeball this stuff and know like right away. Just based on the shape of this thing. Yeah, 1.618. So, you know, I've been trading a while. You just can spot this stuff. And you see these kind of a wave pullbacks like this. And you say, I wonder if they're going to bring it down to 1.5 or 1.68. And maybe if they do, I'll just dump everything. So it's up to you to use other strategies. As the volume starts dying off in the middle of the day, you're not going to get these kind of follow-throughs. And this is the Tokyo post-market and Tokyo session opening up, and that's why you're getting this stuff. So remember, every time you get a flip, you're updating your stop. You know, this is your new stop, and then it gets updated again on the way down. New stop, and then you're finally stopped out. That's it. Not that much maintenance. This is not a lot of maintenance because you're using a 50 and 200 period moving average, weighted moving average. It's not that bad. This is not terrible. So I hope this was informative and that people found this a good strategy. While we're in this plus crazy VIX environment, this strategy is going to continue working, and you're going to continue racking up the points. And this is really the only way to play this stuff, because trying to call bottoms is not smart, and you're gonna end up with losses because you're not doing your due diligence of risk management for trades. And only you will know your risk tolerance on how much you want to use per trade. But remember, since we're buying and selling and shorting so close to the very moving average that dictates whether or not we get stopped out, that's why it works. That's why the 4-8 strategy works, because you're buying against something that is very easy to flip. So if it flips back in against you, you're going to get stopped out very quickly. That's why it's important to get your entry in as close to where your stop is as possible, with some leeway, with some moving around. And that's exactly what you have with some of these moving averages, that they let you get in a trade without getting stopped out right away, and you don't have a hard stop. That's the risk of this. This could explode higher, and you've got to wait for the moving averages to catch up to actually get out of the trade. But you can mitigate those losses over time. Like, let's say this just kept shooting up right here. You can mitigate that over time because you got in early. That's the key. One of the keys is that you're getting into the trade as soon as it flips red. You're starting your shorts on the very next test. Okay? All right. I hope that was helpful to everybody. Let's see if we can get some more of these trades tomorrow. We're building a base, potentially, and there's more to come. We're gonna rack up these points, and you're gonna be so thankful that you did this, because you'll walk out of this and everybody will be so frustrated, and you will have just gone to work every day. Basically, this is work. This is a job. This is not, just make a home run and walk away. This is work. Like, you have to use judgment, and you have to sit here. And a lot of the times I would just say trade the Tokyo pre-market and into maybe 1 hour of the Tokyo session, which is 9 p.m. now Eastern time. It opens at 8 o'clock. And then trade from maybe 9:45 to 11:30, or whenever you get exited out of your trade. So after this trade was done, this long trade that started in your normal time bracket, you would have just said, I don't want to trade anymore. Go to the gym or something. You already scored many, many, many points on S&P 500. So just go do something else and then come back. And it's that simple. And then you're only trading the high volume times of the market. Okay? All right, good luck.